2 years traded darn close to 290. If you look at 10-year, they traded at 323. Right now, all maturities are up 1 basis point, and they're all sticking at very historic levels. Short end, basically 10 years, the 10-year note about 7, and the 30-year bond about 4. But the interesting part of this is, and Bob led off with it, you know, it's about global rates, because as our central bank mops up, as the ECB as October 1st has cut their purchases in half, as the Bank of Japan is looking around deciding it has to also cut back on QE, what we are looking at are the relationships. And even though some of these yields in Japan and Europe have moved up, just consider the spread between our 10s and 10-year boons is about 267 basis points. It's never been this wide. Yesterday it was out to 275. So we need to continue to monitor that. It's going to put pressure on country-specific central banks. And the other issue is that this dance between the equity markets and the treasury markets trying to equate how they harmonize is always a rough process, and it shouldn't be shocking that the big move from a 305 stagnant 10-year note market for 2 weeks, escalating close to 3.25, has made the stock market a little nervous. But really, sometimes it takes a couple of days. Remember, investors are okay with rising rates as long as it's not a persistent headwind in the economy or in the sector of stocks.
Got it. Thank you very much, Rick. Okay, Stephen, what do you think? Are you worried? Is it a persistent worry? Have things really changed? Has the game totally switched around from where we were yesterday, or 2 days ago, I should say?
I think that the rates issue has always been the main concern. I feel like we've done this already. Obviously, to Rick's point, it's the velocity that the rates increase. But Jamie Dimon has commented on it. I think he said, and correct me if I'm wrong, 4% is the rate where it impedes on growth. But others now, it went from 3 to 3.5 to 4. Others feel it could be 5, but it's the velocity that we get there. And I think we've had the preloaded sell-off in emerging markets already. So I'm not sure why we would see any further escalation to the downside in emerging markets. And any sell-off we'd have in domestic has been bought thus far.
Nela, talk to us about this rise in rates. Is it concerning you, or is it based on fundamental data, which is something that in due course we should be positive about?
No, rates are rising, but they're rising for all the right reasons, and that's economic growth. We're seeing really good numbers coming out even today on the non-manufacturing sector. We're expecting a really bullish, strong jobs market number tomorrow. We saw that in the ADP report. So all systems are a go. And what's unusual about current economic conditions is it's unusual for both unemployment and inflation to be this low for this long. But as we return to normal monetary policy, slightly higher interest rates, we can expect more volatility, and I think that's what you're seeing today.
Stephen, was this really Powell's comments that took us this leg lower on equities? I mean, we've known that the economy has been strong, so the stronger data just keeps coming. Was it Powell?
I think it was Powell, but then also yesterday we had J.P. Morgan downgrading EM equities, specifically Chinese equities. We saw the rate velocity. We saw in which that was happening. But for me, I would think that Powell would take his foot off the gas if rates are doing what he wants to do without him involved. Wouldn't you think that would be the natural progression, or am I thinking too dovish on this?
Rick, talk to us about what this rising rate environment means for other markets. Clearly, it's weighed on U.S. equities today, but in real terms, is this going to hurt foreign economies and markets more than it's going to hurt the U.S. market?
Well, I think it will. I think it definitely will. In a very generic, oversimplified form, it makes servicing and hedging the dollar, for example, a bit more expensive. You see countries like China issuing dollar-denominated debt. Only several times in the last 12 to 13 years have they done that. I think it also obviously puts some pressure in the emerging markets. Let's put this into context. Even with the dollar index, basically a lateral move today, we're only a penny away from challenging the current highs that were established in August in the dollar index. And I think the other issue is whether it's carry, commodities, gold, it raises the bar on all of that, and it does have an effect, obviously, on dollar-denominated commodities. But I think in the end, it's also unraveling to some extent the last 24 hours, the yen carry trade, which also I think could be part of the reason that we're seeing this quick exodus out of some of the U.S. equity market.